In August 1982, a quiet meeting took place behind closed doors at the Federal Reserve headquarters in Washington, barely registering in the public consciousness, yet marking the beginning of a financial earthquake that would reshape global power structures for decades to come. Mexican Finance Minister Jesus Silva Herzog delivered an announcement that would reverberate across every continent. Mexico, holder of $80 billion in foreign debt, could no longer service its obligations. Within weeks, 16 Latin American countries and 11 developing nations elsewhere followed Mexico, gas collapse into what the IMF would later term a sovereign debt crisis, though that sterile phrase concealed the human catastrophe of destroyed currencies, gutted industries, and a generation sentenced to what economists coldly labeled the lost decade. Yet while millions saw their savings evaporate and national economies crumbled under the weight of unpayable obligations, a different story was unfolding in the marble corridors of Basel, Switzerland, where the Bank for International Settlements, the central bank of central banks, coordinated emergency financing that would extract wealth from debtor nations and transfer it systematically into the hands of international creditors. This pattern, repeated across centuries in different forms and geographies, reveals an uncomfortable truth embedded in the architecture of modern finance. Economic collapse does not destroy wealth. It merely relocates it. The global financial system operates on a mechanism that becomes most visible during moments of crisis, when the ordinary flows of capital reverse direction and accelerate into what can only be described as organized extraction. When the Latin American debt crisis erupted in 1982, commercial banks had lent aggressively throughout the 1970s to developing nations flush with petrodollars and eager to industrialize, creating debt burdens that ballooned as interest rates rose and commodity prices collapsed. The rescue package assembled by the Federal Reserve, the IMF, and commercial banks followed a precise formula: restructure the debt, provide just enough new loans to pay interest on existing obligations, and impose what the institutions called structural adjustment programs that required debtor nations to privatize state industries, slash government spending, and open their markets to foreign investment. The effect was mathematically elegant and politically devastating. Countries remained trapped in perpetual debt servicing, while their most valuable assets were sold at crisis prices to foreign investors who possessed the liquidity that local populations lacked. This was not conspiracy, but system design, built into the lending relationship itself and activated when the borrower weakened. The Bank for International Settlements has occupied a unique position in this architecture since its founding in 1930, ostensibly created to facilitate German reparations payments after World War I, but evolving into something far more powerful: a coordination mechanism through which central banks manage international financial crises and critically determine who survives them. During the banking panics of 1931 to 1933 that ravaged both sides of the Atlantic, the BIS organized emergency credits for the Austrian and German central banks, establishing precedents for crisis intervention that would repeat throughout the century. When Mexico collapsed in 1982 and Brazil teetered on the edge of default in 1998, the BIS provided bridge financing within IMF-led stabilization programs, effectively acting as the lender of last resort to nations whose central banks faced imminent failure. The institution operates with minimal public oversight, hosting committees like the Basel Committee on Banking Supervision that set global banking standards, determine capital requirements, and fundamentally shape which financial institutions can access international markets and which cannot. Power in the modern financial system flows not from elected governments, but through these networked institutions that operate in what their own literature describes as confidential settings, where central bankers deliberate away from democratic scrutiny. The mechanism by which elites profit during systemic collapse has medieval precedents that illuminate its enduring nature across wildly different economic systems. When the Black Death swept through Europe between 1347 and 1353, annihilating roughly one-third of the continent's population, the immediate effect was catastrophic wealth destruction. Empty workshops, unharvested fields, collapsed trade networks. But within a generation, surviving elites had not only recovered, but dramatically concentrated their holdings. The mega companies of the medieval economy, particularly Italian banking houses engaged in international trade and finance, experienced short-term losses as their debtor networks collapsed and commercial activity ground to a halt. Yet these same institutions emerged from the crisis controlling larger market shares, having absorbed the assets of failed competitors and established unprecedented influence over European monarchies desperate for credit. The De La Pole family of Hull exemplifies this trajectory, rising in 2 generations, from wool merchants to Earls of Suffolk, by becoming the English crown as primary lender during the period when Italian financial networks temporarily fragmented. Most striking was the Medici family, who parlayed their position as papal bankers during the post-plague reconstruction into political control of Florence itself, demonstrating how financial power accumulated during crisis translates directly into governance authority. The pattern operates through several reinforcing mechanisms visible across both medieval and modern crises. First, the sudden devaluation of assets creates acquisition opportunities for those who possess liquidity when others are desperate sellers. Second, the collapse of smaller competitors reduces market fragmentation and allows larger, better capitalized entities to consolidate control. Third, governments in crisis become dependent on whoever can provide immediate financing, creating relationships of structural dependency that persist long after the emergency passes. During the Black Death, surviving laborers theoretically gained bargaining power through scarcity, yet the actual redistribution of wealth moved upward rather than downward because property ownership, trade networks, and access to credit remained concentrated among those families who possessed diversified holdings and could weather short-term disruptions. This is the crucial insight. Systemic collapse does not reset power structures, but rather accelerates their concentration, as crisis conditions favor those with access to capital reserves, political connections, and the information networks necessary to anticipate and exploit market dislocations. Germany's hyperinflation between 1921 and 1923 provides the most documented case study of how currency collapse functions as a wealth transfer mechanism from savers to debtors and from the general population to those positioned to exploit monetary chaos. The Weimar government faced an impossible situation after World War I. Massive war debts denominated in paper marks, reparations, obligations payable in gold or foreign currency, and an economy devastated by 4 years of total war. When French forces occupied the Ruhr industrial region in January 1923 to enforce reparations payments, the German government instructed workers to engage in passive resistance and printed currency to pay their salaries, triggering the final acceleration of inflation that saw the exchange rate collapse from 320 marks per dollar in mid-1922 to 4.2 trillion marks per dollar by November 1923. The standard narrative treats this as governmental incompetence or desperation, yet Reich Chancellery records reveal that officials understood that hyperinflation served specific functions. It eliminated domestic war debts denominated in marks, making them worthless in real terms, and it created practical obstacles to reparations payments by destroying the currency's value. The distributional consequences were stark and deliberate. Anyone holding cash, savings, bonds, or fixed income instruments denominated in marks saw their wealth vaporize. Pensioners who had accumulated lifetime savings found them worthless, creating widespread destitution among the middle classes who had financed the war through patriotic bond purchases. Meanwhile, those who held real assets, land, factories, commodities, or foreign currency, not only preserved their wealth, but could acquire additional assets at fire sale prices from desperate sellers. Most significantly, anyone carrying debt denominated in marks found their obligations erased in real terms. A mortgage taken out in 1919 could be repaid in 1923 with currency worth less than a postage stamp. This created a new class of profiteers, individuals and corporations who had borrowed heavily in the period before hyperinflation and effectively received their acquisitions for free. Public anger focused not on the abstract mechanisms of monetary policy, but on the visible reality of rich profiteers who seemed to prosper while ordinary Germans faced starvation, feeding support for extremist parties that promised to restore order and punish the beneficiaries of financial manipulation. The lesson embedded in Weimar is that currency collapse does not destroy value uniformly, but redistributes it according to the structure of assets and liabilities, and those who understand this structure in advance position themselves accordingly. The collapse that began with the 1929 stock market crash and accelerated into the Great Depression demonstrates the mirror image of Weimar as inflationary transfer, deflationary collapse that systematically moved wealth from debtors to creditors and from the working population to those holding cash and financial claims. By 1933, real GDP had fallen 29%. Unemployment reached 25%, consumer prices dropped by a quarter, and wholesale prices by nearly a third. Yet this destruction of nominal value concealed a brutal process of real wealth transfer. The Federal Reserve's failure to prevent the 30% collapse in money supply between 1930 and 1933 created what economists call debt deflation. As prices fell, the real value of debt burdens increased, forcing borrowers to pay back loans in dollars worth significantly more in purchasing power than those they had borrowed. This was not theoretical. 16,000 businesses failed in the final 6 months of 1893 alone during an earlier financial panic, and the Great Depression saw waves of bankruptcy that dwarfed that precedent. The paradox of debt deflation is that the harder debtors struggle to repay, the worse their situation becomes. As individuals and businesses liquidated assets to service debts, the sale of those assets drove prices lower, increasing the real debt burden further in a self-reinforcing spiral. Banks that survived the initial panics became extraordinarily conservative, building capital reserves and refusing new lending, which intensified deflationary pressure and ensured that those with existing debt obligations faced ever harsher terms. Meanwhile, those who entered the Depression holding cash or liquid assets rather than debt found their purchasing power increasing automatically as prices collapsed, allowing them to acquire real estate, businesses, and securities at historic discounts. The inequality that had characterized the 1920s, when the wealthiest third of Americans controlled a third of all national wealth, while the poorest possessed virtually no savings, actually intensified during the Depression years, despite, or rather because of, the nominal destruction of asset values. Some wealthy families lost everything, particularly those whose fortunes rested on leveraged stock market positions, but others used the crisis to consolidate holdings, purchasing distressed assets and emerging from the 1930s with larger relative shares of a temporarily smaller economic pie. President Roosevelt's Executive Order 6102 in April 1933, which made private ownership of gold certificates, coins, and bullion illegal, exemplifies how crisis conditions enable extraordinary exercises of state power that redistribute wealth and restructure the monetary system. The Federal Reserve had reached its legal limit on credit expansion relative to its gold reserves, meaning that any reduction in gold holdings required an even larger reduction in available credit, exactly the opposite of what Depression conditions demanded. By confiscating private gold at the official price of $20.67 per ounce, and then immediately revaluing gold to $35 per ounce, the government effectively expropriated nearly 40% of the value from citizens who had saved in the monetary metal while simultaneously expanding the government's own capacity to issue currency. This was wealth transfer through administrative fiat, justified by emergency but permanent in effect, and it established precedents for how governments manage systemic financial crises by rewriting the rules of property rights and monetary obligations when the existing system threatens to collapse entirely. The 2008 financial crisis crystallized the modern pattern of elite profit during systemic collapse with unprecedented clarity, as the mechanisms of bailout and quantitative easing transferred trillions of dollars from public coffers to private financial institutions, while ordinary households experienced the largest destruction of middle-class wealth since the Great Depression. When Lehman Brothers collapsed in September 2008, triggering panic across global financial markets, the United States government responded with the Emergency Economic Stabilization Act, creating the Troubled Asset Relief Program that authorized the Treasury to purchase up to $700 billion in troubled assets and equity positions in distressed banks. This figure represented only the most visible component of a far larger intervention that included capital infusions into Fannie Mae and Freddie Mac, expanded federal loan guarantees, and most significantly, the Federal Reserve's unprecedented asset purchase programs that would eventually expand its balance sheet by trillions. The geography of these wealth transfers reveals their underlying logic. Research on bilateral external positions during the crisis shows that valuation changes on international equity, direct investment, and debt portfolios created massive redistributions, depending on the structure of countries, external holdings, and exposure to asset-backed commercial paper conduits and dollar funding markets. Those entities, primarily large financial institutions, positioned on the right side of these exposures, gained enormously, while those on the wrong side experienced catastrophic losses that, in many cases, required government rescue. The crucial point is that rescue was selective. Institutions deemed systemically important received unlimited support, effectively guaranteeing their creditors and equity holders against loss, while smaller banks, homeowners, and ordinary businesses faced the full force of market discipline. This created a moral hazard of historic proportions, where the largest and most reckless financial actors learned that their risk-taking would be underwritten by taxpayers, establishing incentives for even greater leverage and speculation in subsequent cycles. Central banks in emerging markets followed similar patterns during the COVID-19 crisis, implementing asset purchase programs ostensibly to reduce financial stress and provide macroeconomic stimulus, but raising concerns about fiscal dominance and debt monetization. The IMF's analysis emphasized that such programs should be temporary, limited in scale, conducted at market prices, and focused on genuine market dysfunction rather than permanent financing of government deficits. Yet the distinction between the emergency liquidity provision and permanent wealth transfer becomes difficult to maintain once programs are established, particularly when stopping them would trigger the very market collapse they were designed to prevent. The deeper issue is that asset purchases systematically benefit asset holders, who are disproportionately wealthy, while doing little for those whose wealth consists primarily of labor income, creating a mechanism by which crisis response itself exacerbates inequality even as it stabilizes nominal market prices. The 1997 Asian financial crisis demonstrated how international financial institutions deploy structural adjustment as a mechanism for transferring ownership of emerging market assets to foreign capital during moments of currency and banking collapse. The crisis began in Thailand, where decades of high interest rates had attracted massive foreign capital inflows, seeking superior returns, creating asset bubbles, and accumulating enormous foreign currency debt burdens. When the Thai baht came under speculative attack and the government exhausted its foreign exchange reserves defending the peg, the currency collapsed, triggering capital flight that cascaded across Southeast Asia and eventually reached South Korea and Japan. The immediate effect was devastating. Currencies lost half their value or more, stock markets plummeted, private debt denominated in foreign currency became unpayable, and governments faced the impossible choice between allowing complete financial collapse or accepting IMF rescue packages with stringent conditions attached. The conditions reveal the template. In exchange for $58.4 billion in bailout funding, the IMF required Korea to raise the ceiling on foreign investment in domestic companies from 26% to 100%, effectively opening the entire corporate sector to acquisition by foreign capital at crisis-depressed prices. Financial sector restructuring closed or merged 787 institutions by 2003, with surviving banks often ending up under foreign control. Newbridge Capital, S. takeover of Korea. First Bank exemplifies the pattern of distressed asset acquisition by international private equity during IMF-managed crises, the requirement for transparency in financial systems, while seemingly technical, functioned to eliminate informal financing networks and relationship-based lending that had characterized Asian development models, forcing adoption of Western financial structures that advantaged foreign institutions with superior access to international capital markets. Thailand, Indonesia, and other affected countries experienced similar forced restructurings, with domestic industries sold to multinational corporations and banking systems reoriented toward international rather than development finance. The political economy of these interventions is significant. Countries that resisted IMF programs or maintained capital controls, most notably China and Malaysia, experienced less severe crises and preserved domestic ownership of strategic industries. China wore its symbolic refusal to devalue its currency, won international praise, and positioned it as a regional stabilizer, while its $4 billion contribution to bailout packages bought political influence. Meanwhile, the nations that accepted IMF conditions in full suffered what critics termed policy-induced depression, where austerity requirements deepened recessions. And asset fire sales transferred ownership to foreign entities at precisely the moment when domestic purchasing power had collapsed. The lesson learned by many Asian governments was not the Washington Consensus narrative of market-oriented reform, but rather the necessity of building massive foreign exchange reserves as insurance against future crises, leading to the accumulation of trillions in dollar-denominated reserves that effectively subsidize American deficit spending. The crisis thus created a new architecture of dependency, where emerging markets finance consumption in developed nations while remaining structurally vulnerable to capital flight and currency collapse. In the early 21st century, the balance of power between governments, markets, and citizens has tilted in a way that makes the outcomes of the next systemic crisis disturbingly predictable. The architecture built after 1945, Bretton Woods institutions like the IMF and World Bank, the Bank for International Settlements, and national central banks, was justified as a shield against the chaos that produced the Great Depression and 2 world wars. Yet over time, these institutions have learned to manage not only crises, but also their distributional consequences. When the global financial crisis struck in 2008 and when the COVID-19 pandemic hit in 2020, the response was remarkably consistent. Protect systemically important financial institutions first, stabilize key asset prices second, and only then apply fiscal or social measures to the broader population after the commanding heights of the financial system had been secured. The sequence matters because it reveals who must be saved to prevent systemic collapse, and who can be asked to bear the adjustment cost afterward. In advanced economies, the post-2008 world entrenched a strange dual reality. On one side, interest rates hovered near zero or below for years, allowing large corporations and financial entities to refinance, roll over, and leverage at historically cheap levels, while asset purchase programs ensured that demand for bonds, equities, and property remained robust. On the other side, entire generations entered labor markets where real wage growth stagnated, job security declined, and retirement systems quietly shifted risk from governments and employers onto individuals. In this environment, those with pre-existing capital participated in the upside of artificially supported asset prices, whereas those whose primary income came from work were given only the slow, uncertain channel of employment in economies increasingly dominated by financial considerations. The system resembled a pressure cooker. As long as credit flowed and asset prices remained elevated, the contradictions could be managed, but any serious disruption threatened to expose how much of the apparent prosperity depended on interventions that operated quietly in the background. The institutions that shape crisis outcomes today are not secretive cabals, but formal legal structures, whose mandates and tools are publicly documented, even if their deliberations are often shielded from public view. Central banks hold the power to create base money, set benchmark interest rates, and decide which assets to purchase and at what scale, effectively acting as both referee and increasingly dominant participant in financial markets. Multilateral institutions like the IMF determine the conditions under which distressed nations receive life-saving liquidity and the policy adjustments they must accept in exchange, while development banks and export credit agencies steer capital toward projects that align with national and corporate strategies. Behind all of this lies a network of large private financial institutions, global banks, asset managers, insurance companies, plugged directly into these decision-making centers through advisory roles, market operations, and regulatory consultations. What makes these structures so resilient is not only their legal authority, but their ability to frame their actions as technocratic necessity rather than political choice. When a crisis erupts, the language becomes clinical. Liquidity provision, balance sheet repair, macro-prudential stability. Yet each of these terms conceals distributional decisions. When a central bank chooses to buy corporate bonds rather than extend direct support to households, it is making an implicit judgment about which part of the system must be preserved at all costs. When an international institution demands austerity, cuts to public services, reductions in subsidies, privatization of utilities, in exchange for loans, it is deciding that creditors will be made whole while the adjustment burden falls on citizens who never signed a debt contract. The elites who profit are embedded in this apparatus, executives whose institutions are rescued at par when markets would have priced them at pennies, investors whose portfolios rise on the tide of new liquidity, and political actors whose careers and influence depend on maintaining access to this decision-making ecosystem. As debt levels rise relative to economic output, the system becomes more sensitive to shocks, and the scale of intervention required to stabilize it increases with each cycle. Sovereign debt in many advanced economies now stands at levels that would once have been associated only with wartime conditions, yet interest expenses remained manageable for years because rates were suppressed by central banks determined to avoid deflationary spirals. This created a dependency loop. Markets came to expect intervention whenever volatility spiked, and policymakers became trapped by their own past successes, knowing that failing to act at the next sign of stress could trigger the disorder they had repeatedly postponed. Meanwhile, demographic shifts, slowing productivity growth, and geopolitical fragmentation added structural pressure, reducing the space for painless adjustment and making it harder to grow out of debt burdens through real expansion. In such an environment, crisis does not appear as a single dramatic event, but as a series of overlapping disruptions. Energy shocks, supply chain breakdowns, regional conflicts, banking tremors gradually erode trust in existing arrangements. Each episode justifies another round of extraordinary measures. Targeted credit programs, asset purchases, guarantees, swap lines, backstops. With every intervention, the line between market and policy blurs further, and the list of institutions deemed too important to fail grows longer. Officially, these measures are temporary, yet withdrawal becomes almost impossible, because markets have reorganized themselves around the assumption of ongoing support. The result is that the next true systemic breakdown, when it comes, will land on a landscape where public balance sheets are already heavily burdened, central bank tools are less effective, and political tolerance for further bailouts has been eroded. Yet the underlying hierarchy of who gets rescued first is likely to remain unchanged. The central revelation, once the historical and contemporary pieces are placed side by side, is that systemic collapse is not an aberration, but a recurring sorting mechanism. When currencies fail, when banking systems freeze, when sovereigns default, the event exposes the structure of claims underneath the surface narrative of prosperity, and that structure is never neutral. Those who hold claims closest to the monetary spigot, those whose liabilities are implicitly or explicitly guaranteed, and those with the point liquidity and legal access to buy distressed assets are repeatedly lifted out of the wreckage and placed atop the new order that emerges. For the majority, collapse is experienced as loss of jobs, savings, homes, security. For a minority positioned at the strategic junctions of credit, policy, and information, collapse is experienced as opportunity, a moment when prices disconnect from long-term value, and when rules can be rewritten under the cover of emergency. This does not require a hidden conspiracy or a single mastermind pulling strings. Rather, it reflects the logic of a system where power accumulates wherever control over credit, currency, and legal enforcement is concentrated. The elites who profit from collapse are those aligned with that control, whether they sit in central banks and finance ministries, on the boards of global financial institutions, or in corporations whose business models depend on access to state-backed liquidity and guarantees. They do not need to engineer crises. They need only to be prepared for them, holding liquid claims when others are leveraged, maintaining political relationships that ensure rescue when others are abandoned, and deploying capital quickly into whatever assets distressed sellers are forced to relinquish. The pattern seen from the Black Death to Weimar, from the Great Depression to Latin America, from Asia in 1997 to the global crisis of 2008, is that the system itself selects for actors who can navigate collapse as a business environment rather than an existential threat. If there is a narrow window of agency in this story, it lies in understanding the mechanisms before they are activated in full force again. History suggests that ordinary citizens, small businesses, and even mid-sized nations are not doomed by fate to be perpetual losers in every systemic reset. But they are consistently disadvantaged when they misread what money is, how debt works, and who writes the rules in times of emergency. Those periods when the distributional impact of crises has been softened through debt jubilees, progressive taxation, social insurance, or capital controls did not arise spontaneously from markets, but from deliberate political decisions taken in the aftermath of trauma. The post-1945 settlement in many countries, with its mix of welfare states, strong labor protections, and regulated finance, was born not out of generosity, but out of the recognition that allowing another Great Depression-style collapse of legitimacy could be fatal to existing elites as well. The trajectory since the late 20th century has reversed many of those safeguards, returning the system closer to its earlier, more brutal form, where private losses are socialized upwards and public burdens are individualized downwards. The next major systemic break, whether triggered by unsustainable sovereign debts, climate-driven shocks to production, geopolitical fragmentation of currency blocks, or some unforeseen catalyst, will occur in a world more unequal, more financialized, and more interconnected than any that preceded it. Who profits and who pays will not be random. It will follow lines traced long in advance: ownership of real productive assets versus fragile financial claims, access to institutional backstops versus exposure to unprotected markets, capacity to influence rulemaking versus subjection to rules written elsewhere. Recognizing this is not an invitation to despair, but a challenge to see collapse not just as destruction, but as a brutally efficient mirror that reflects the true structure of power in any given era, and to decide, before the mirror shatters again, where one stands in relation to it.